Good afternoon, everyone, and thank you so much for joining our webinar today, Open Forum, Achieving Compliance Success in 2017. My name is Amanda, and I'll be your moderator today, and ERISA attorney Larry Grudzien is our presenter. We all have a lot of questions with the legislative changes coming, so if you miss something, don't worry. We'll be emailing you a recording and the slides after the webinar concludes. Since we have such a small group, I'll be unmuting everybody who's listed as attentive so that you can ask your questions when Larry pauses periodically. Or if you'd feel more comfortable, or if you don't have a microphone, you can always type your question in the question box below, and I'll read it aloud for you when Larry pauses. Our next webinar will be on April 4th at 1 p.m. Central, and we'll be covering how to distinguish an independent contractor from an employee. For now, I'm going to turn the presentation over to Larry.
Amanda, thank you very much. Every year or two, I present this seminar, and basically what it is, it's a series of questions that I'll be discussing, and these are based on questions I've gotten from my clients in my practice. What it's going to do is hopefully help you maybe trigger some questions on your side, so you can again. So this is an opportunity to ask me any question on these areas that you want. So what are we going to be covering today? We're going to be covering tax issues, ERISA issues, COBRA issues, HRA issues, HSA issues, and healthcare reform. Now, one thing to healthcare reform is going to heat up over the next probably 2 to 3 months. Later this week, there's going to be a vote in Congress on the new health bill. So let's see what happens, and this may be the first step in the 3-step process. So we're going to watch it very closely and hopefully have some, once things are settled, we'll have something for you explaining what's going to be happening over the next year or two. So let's look at the tax issues. What I've created here is a series of questions that kind of capture some of the issues that I've been seeing in benefits. So let's look at some of the issues. Here's the first question. My employees purchase fixed annuity benefits with before tax contributions through a cafeteria plan. Are any of these distributions from these benefits taxable? A few months ago, and this was in January, the IRS released a general counsel memorandum that said, and what these fixed annuity contracts, annuity benefits are, basically if you get injured, and it's like $30 a day for hospitalization. If you have emergency room, you get $50. That type of thing, and many times these particular benefits are voluntary, but for the convenience of the employer, or for the employee has these contributions go through a cafeteria plan. In fact, one of the providers at FLAC was actually giving cafeteria plan documents out. Now, so the question is, are these distributions of these benefits taxable? And if it's with pre-tax dollars, what the IRS indicated in this General Counsel memorandum that was released January 20th was the fact that they felt that these plans were not medical expenses. And if these premium payments were made on a pre-tax basis, any distributions coming out of that would be taxable. Now, as I indicated before, many of these benefits are voluntary, which means it's individual contracts, and the problem is the employer may not know that individuals have claims because they go directly to the insurance company. Many times the employer is not that involved. So the issue is, and the next question is, if taxable, does the employer have any withholding responsibilities? And the answer is yes. Because it's when you put these voluntary benefits through a cafeteria plan, they become employer-sponsored benefits, and therefore the employer has an issue and a problem, because these distributions should have been taxable, and there should have been income tax, Medicare and Social Security taxes withheld from these. And the employer has a big problem because they may not know if one or more of their employees actually received a distribution. It's a real problem. So the issue is, if you're sponsoring one of these, what do you do? do you go back to the insurance company and say, you know, we have to reissue all our W-2s because they're incorrect, and do you have a record of who received what so we can tax it? Many employers have decided, let's sleeping dogs lie. We're going to start with post-taxing these contributions, so we're not going to have any liability in the future, and they're just going to cross their fingers for the past, which I wouldn't advise doing it because there could be an issue because your W-2s are incorrect, your withholding is incorrect, your under withholding, all these different taxes. So there could be a big issue if you're, and many employers are sponsoring these programs. Let's look at the set of questions. For completing a health risk assessment under a wellness program, the employer gives employees a cash benefit of $50. Is that payment taxable? And the answer, the IRS has said yes, because it's not in the form of a reimbursement of medical expenses. So in that situation, that payment of $50 would be taxable to the employee. Now let's switch the situation around, and let's say instead of giving the employee cash, and the next question is, would the answer be different if the employer gave that payment in the form of a flex credit, or gave it in the form of an HSA contribution, or reduced their premium? And the answer is the situation then would be different, and that payment would not be taxable. It would be seen as an employer contribution to those plans. It would have to be tested, but by changing the nature of the payment, then it comes from being taxable to non-taxable. Extremely important, because many employers are doing all kinds of things to encourage people to participate in a wellness program, and cash payments are very popular. So again, you may want to rethink giving an employee a cash payment and maybe do it in the form of a contribution to a HSA and a flexible spending account. I mean, there's various ways you can do it, or just as a discount to any premium payments that the employee would have to pay. Let's move on. For waiving health coverage, my employer gives employees a cash payment of $100 a month. Is this payment taxable? And again, similar to the wellness situation, the answer would be yes, because it's given out in cash. Now, this situation has all kinds of ramifications behind it, because basically what that employer is doing is creating a cafeteria plan. And the problem is, because you're giving the employee a choice between cash or benefits. And if that choice is not under a cafeteria plan, then those employees who took the coverage would also be taxed. So please, if you're going to give, and many employers call it various names, they call it an opt-out benefit, they call it all kinds of other things. So if you receive cash, it's taxable. But if you want to avoid those employees who took the coverage not to be taxable, that choice of the opt-out payment would have to be through a cafeteria plan. Very extremely important, and you would just add the cash benefit as one more benefit under the cafeteria plan. Next question. A new employee is covered under his old employer's coverage under COBRA. He wants the new employer to pay for it for that coverage. Is that payment to him taxable? It depends on how the employer structures and where it's coming from. If it's basically just coming from the employer itself, then that payment would be taxable. But if it's paid under an HRA or any type of reimbursement arrangement, it could be non-taxable because it's payment of premium. So it all depends how the employer would want to structure it, but you can make it so that payment could be non-taxable. But if you give the employee just pure cash in that situation, then that payment would be taxable. So you got to be really careful how you structure stuff. Amanda, are there any questions?
Moment while I look, and everyone is unmuted except for a couple people who had background noise. So if you try to speak and find that you are muted, you can just click the raise hand button and I'll unmute you. We do not have any typed questions at this time, so if you have any, please say them out loud or type them below or raise your hand and I can unmute you.
Okay, cool. These are some basic ERISA questions, but the reason why they're there is because I keep on being asked these questions over and over again. So let's go through the questions on this page. Do non-for-profit employers have to comply with ERISA? And the answer is yes. There's a lot of misconceptions in there. Just because you don't pay tax, ERISA doesn't apply to you. Now, what employers do not have to comply with ERISA? There's two types of employers that don't have to comply with ERISA: governmental employers, and then those employers that sponsor church plans. So if it's a church plan, it comes under the definition of a church plan. Those two employers don't have to comply with ERISA, which means they don't have to have a plan document. They don't have to meet the SPD rules. They don't have to file a 5500. So all the different requirements of ERISA do not apply. But again, the biggest misconception I've seen is that people think just because I'm not for profit doesn't mean I have to comply with ERISA. That is not true. Now, another misconception is the fact that, well, because I'm not subject to ERISA, then the tax rules don't apply to me. I don't know how many times I visited schools and I visited various other governmental entities that sponsor, for example, certain self-funded plans that are subject to the non-discrimination testing under 105H, and they're under the misconception because I'm a governmental entity, the tax rules don't apply, which is not true. So please understand that. What's becoming real popular, especially as employers grow, can an employer have different renewal dates for benefits contained in a wrap plan? A wrap plan is basically where, suppose you're sponsoring a health plan and medical, dental, group health, and AD&D. And as years go on, the participation in your plans reach a certain point where you have to file a 5500. And depending how you structure your plan, you could have a number of different 5500s or just one. The way to reduce the number of your 5500s is having a wrap plan. And a wrap plan basically has its own plan year. And that's where you, again, file your 5500 under the plan year of the wrap plan. And then what you could have underneath that plan is a number of different benefits with different renewal dates that end during the wrap plan's plan year. And that's fine, you can do that. The only issue and problem is you have to look at the law to see, and sometimes, and when you look at changes, especially under ACA, the effective dates of any changes could be based on your ERISA wrap plan year. So you may want to look at that and make the ERISA plan year the same as your medical plan, either policy year or plan year, just to make sure you don't have different dates. So why is the plan year so important? The plan year is important because of really two or three reasons. One, if you have to look at the tax code, but some changes effective during a plan year, and if you have a wrap plan, it's based on the plan year. Two, that's when you file your 5500. So again, the plan year is you have to state that in your wrap document. So please make sure if you have a wrap plan, you look at this, because if you have a wrap plan year that's different than your medical plan, all the ACA changes, at least most of them, were based on a plan year, which is their ERISA REP plan year. When is an employee assistance plan and or a wellness program subject to ERISA? I've run into this so many times, and there's various aspects of employee assistance programs that rise to providing medical benefits. And the DOL have a number of different guidance out there from the 90s that basically outline that in your employee assistance program, if you have a nurse helpline and you're providing assistance instead of just referrals, in that situation, then that employee assistance program would be considered an ERISA medical plan, and therefore a couple of things are real important. You have to have a plan document, an SPD, and what's also very important, you may have to offer the employee assistance program under COBRA. So if you have enough medical assistance in this employee assistance program, we have nurse helplines. It's just not a referral plan. In that situation, that would be considered to be a ERISA medical plan program, and therefore COBRA would apply. Let's move on to wellness programs. The rules on wellness programs are less developed, and the guidance is still pretty sketchy, but basically what they've indicated is if your wellness program contains diagnostic testing, for example, disease management, other programs like that, then in that situation, that wellness program would be seen as again, a medical plan under ERISA, and therefore you would have to comply with having a plan document and an SPD, and if you have 100 participants or more, you have to file a 5500. So those programs are becoming very popular, and what's interesting about it, many employee assistance programs are offered through either disability programs or group term insurance programs, and the insurance companies don't understand the rules on this and may give you different advice. All right, this next slide 9 is a funding issue, and this comes up every so often. If you have a self-funded plan, most employers pay claims out of an account in the employer's name. And if you do that, if you don't put it in the plan's name, then it's not considered to be funded. Now, funded is extremely important because once your plan is funded, then you have to file a 5500. So the question is, can an employer put the name of the plan on a checking account? And the answer is yes, you can, but the ramifications behind it is that now you've created a funded plan, and therefore then you have to change your 5500, you have to file one, and it's considered to be funded, and that's considered to be a plan asset. Now, once you do that, that plan asset under ERISA has to be held in a trust. So all these different rules come into play, and you have to be very careful. So please avoid anytime putting the name of the plan in any type of checking account or savings account, because what you've done, and what happens if the employer does that, again, you have to set up a trust, you have to file a 5500, and all the fiduciary rules come into play because now you have plan assets. All right. What is the penalty for not filing a 5500? It's over $2,000 a day. But please remember, there is a delinquent filer program that reduces it to $10 a day. So again, if you have not filed your 5500s in the past, there's a delinquent filer program that really cuts down the penalty. And the maximum penalty that you pay under that program is, again, $4,000 for all years. So again, if you start a new job or you miss a plan and you haven't filed it for years, don't worry, there is a delinquent filer program that can help you. Now, what I've run into many times is something called a MEWA. That's the next question on slide 9. And a MEWA stands for a multiple employer welfare arrangement. And the reason why the question's there, I've been running into it more and more. And basically how it comes up in two different areas. Now, the meaning of a multiple employer plan is when you have unrelated employers participating in the same medical plan program. And this happens generally in two different situations. You have an investment group, and they own hotels and restaurants. And it's run by a management company. And each location of a hotel or restaurant is a different set of investors. Sometimes they're related, sometimes they're not. And in that situation, for ease of convenience, because but the amount of the investors don't rise to being under a control group. You could have 25, 30, 35, 50, 55% common ownership, but it doesn't rise to 80%. And so in that situation, if they put everybody onto one plan, you could be creating a MEWA. Another situation that could create a MEWA is a situation where you're inviting independent contractors to participate under your plan. This is a very common experience. Many insurance companies allow that, but again, by allowing independent contractors, 1099 employees participating under your plan, basically what you've created is a MEWA. Now, what's important to understand in the state of Illinois, self-funded MEWAs are prohibited by state law because they see it as a dodge against the insurance rules. So again, be very careful, and especially if you're operating in a number of states and your health plan is operating in, if you have a MEWA, state rules will apply to your plan if you have substantial number of employees in those states. And in some states like California or New York, in Florida, in order to sponsor a MEWA, you have to be in an association, so it could get rather interesting. Also in that situation, there is a form called an M1 you have to file. And also the under 100 limitation for filing at 5,500 doesn't apply to MEWAs. So it creates all kinds of issues and problems. So how does this apply to employers? Again, when you let unrelated employers, not part of your control group, participate under your plan. And they're participating and they're not related. So that's when a MEWA is created. So when is it created? Again, when you allow unrelated employers, either employees or employers, participating in your plan. It creates all kinds of issues and problems. And again, in most situations, if you're insured, there's not that much of a problem. But once you become self-insured, what the states try to do is prohibit them because they see self-insured MEWAs is a dodge around the insurance rules. So you're going to be real careful. In my practice, I run into it at least once or twice a week, where inadvertently groups will let employers join their plans, not realizing the ramifications behind such an endeavor. Amanda, are there any ERISA, other ERISA questions?
Let me take a look. Again, if you have a question and you find yourself muted, you can just raise your hand. I do have, is the trust set up individually for the business, or can the TPA set it up?
Well, it's under the name of the business, but it's a separate entity. And remember, the trust is a VEBA trust, so you have to meet the requirements of 50109. You have to apply for a tax exemption, which is a Form 1024. So each year, when you have a VEBA, you have to file a 5,500 and a 990, which can get rather expensive. So that's why employers want to avoid at all costs funding the plan, because it creates all kinds of issues and problems. Now, if you're large enough and you have a lot of self-funded benefits where you want to run through a trust, it makes a lot of sense, because one of the advantages being self-funded is that you can get a deduction for creating a reserve, money set aside for the future. And that could increase your deductions as opposed to being insured, and you can only deduct your insurance premiums. So if you're self-insured, and in many benefits you can create a reserve and get a bigger deduction, but it comes at a cost. The cost is maintaining, establishing and maintaining a VIVA.
All right. I believe that's it for right now.
Okay. Another area I want to talk about is COBRA. We've done seminars on COBRA a lot, and there's a series of questions that I've come up with that kind of talk about some of the complexities of COBRA. This is the very common question I get: can qualified beneficiaries add benefits at open enrollment? Remember, anyone who is covered, either the employee, the spouse, or dependents, who is covered at the time of the qualifying event is considered to be a qualified beneficiary. The qualified beneficiaries have independent rights under COBRA. Now, one thing to remember under qualified beneficiaries, while they're eligible for COBRA, they are treated as same thing as a active participant. So they have a right to add benefits at open enrollment. So if you had an employee, for example, who at the qualifying event, when let's say they got terminated or had a reduction of hours, they only had dental. At the next open enrollment, they want to add medical and vision. In that situation, because active participants have that right, qualified beneficiaries also have that right of adding benefits, those benefits they didn't have at the qualifying event. So that's extremely important to understand, and many employers don't understand that and say, well, since you only had one benefit at the qualifying event, you can't have any other. And that's not true. Another common situation, if coverage ends for retirees, does the employer have to give them the right to elect COBRA? And the answer to this, it depends. What many employers do, they may end retiree medical at age 65 because then Medicare kicks in, and it's much cheaper for that retiree to get a supplemental program. It's much cheaper, much less cost than the employer's plan. So they say, okay, once you reach 65, I'm sorry, you're on your own. The retiree coverage ends. And the question, the employer comes back to me and says, well, at that point, do I have to offer the employee and their family, because their coverage is ending, COBRA? And the next question I ask that employer is, well, what'd you do at when that person terminated employment? And they said, well, we offered them the retiree coverage. And generally, for employees that are under 65, what most employers do, if they do offer retiree coverage, is to continue them on the active employee plan. They don't have a special retiree coverage. Now, remember, to offer coverage, COBRA, there has to be two things that happen. There has to be a qualifying event, which we do. We have a termination of employment. The second is a loss of coverage. So in this situation, when the employer says you can continue on the active plan, what is the loss of coverage? In most situations with retirees, the employer will offer that active employee plan to that retiree at a different cost, many times more than if they were active. Let's say they paid 80% of the active employees' premium, retirees only 50%. According to the Labor Department, that is a loss of coverage because of the difference, and that triggers COBRA. So if an employer at that time offered the employee the choice of COBRA or the retiree coverage, and that employee picked the retiree coverage, later, when that person reached 65, they terminated the retiree coverage. They don't have to offer them COBRA because they already did that when they terminated, maybe at 55 or 60. But if the situation is the employer didn't know any better and didn't offer COBRA and they terminated retiree coverage, then they would have to offer them COBRA. So again, you got to be real careful in this situation and make sure you follow the rules on this. The next situation is a very common situation. If an employee drops coverage at open enrollment, at annual enrollment, excuse me, does the employer have to offer his or her spouse COBRA? And remember, in this situation, there has to be two things. There has to be a loss of coverage, which there is, but there also has to be a qualifying event. In this situation, these raw facts, there's no qualifying event. But let's add the situation where he's divorcing his or her spouse. He's filed for divorce, and now the divorce is not final. It would be final in a few months. So when the employee does drop that spouse because he filed a divorce action and it's final, that employee then would be eligible for COBRA because the divorce is a qualifying event. So you have to ask questions when that employee drops coverage about why they're dropping it, and could there be a divorce lurking, which is going to be a really interesting situation to ask about. But I mean, that could be the reason why that employee is dropping coverage. Now, this is a very common question I get. Can a COBRA participant drop coverage at any time? And generally I say, well, they can only drop coverage if they have a qualifying event. But the other reality is the employer can drop coverage at any time but not paying the premium. Now, that could affect other qualified beneficiaries, but the way that if the employee doesn't want COBRA, doesn't want coverage any longer, they could just drop coverage, is not just paying the premium. So in essence, they can, but not just paying the premium. If an employee goes on leave, not covered by family and medical leave, does the employer have to offer them him or her COBRA to continue coverage? And probably once or twice a week, I get situations where somebody is off on workers' comp, next question, or they took a leave of absence that doesn't qualify for family and medical leave. And so they asked me, what do you do in this situation? I said, well, look at your insurance contract to say, what are the rules for continuing coverage? And most insurance contracts for health insurance indicates that employee has to be active. And if they go on leave, the only two ways that employee can continue coverage is by being eligible for family and medical leave or for COBRA. So in order for that employee to be covered, you have to offer them COBRA because that's a reduction of hours, and that's a COBRA qualifying event. So again, the only way in that situation that you can continue coverage is by offering them COBRA. Now, would the answer be different if the employer went on workers' comp? And this is a biggest misconception that people have, that for some way workers' comp guarantees coverage, and the answer is no, it does not. It continues coverage for that injury, but not for general medical coverage. So under workers' comp, in order to continue coverage, as I said in the beginning there, in order to continue coverage, you have to determine whether that employee is eligible for Medicare, for family and medical leave, or for COBRA. That's the only way that coverage can continue. Amanda, do we have any questions about COBRA.
Yep, just one moment. Can an employee add a spouse or dependent coverage at open enrollment on coverages they already have or on new coverages they are adding?
Yes, but those individuals will not be qualified beneficiaries. Remember, the employees have the same right, the qualified beneficiaries have the same rights as active employees. So they have the right, but again, those new dependents would not be a qualified beneficiary. So they would not have independent rights. So if for a few months later that qualified beneficiary decided to drop coverage, their coverage would go by the wayside.
All right. And we had one hand up who I've unmuted now, Joseph. I'm not sure if he has a microphone. If you have any questions, you can, oh, there we go. If any employee is covered on their spouse's plan and they have different open enrollment dates and the employee wants to come on their employer plan at their open enrollment, can they drop off the spouse plan even though it is not the spouse's open enrollment?
In that situation, we have a situation where the employer can let the spouse drop coverage and join the employer's plan. But extremely important to do two things in that situation before you drop coverage. One, you have to check your cafeteria plan to see if that's one of the qualifying events on your cafeteria plan. And two, most importantly, check with your insurer if that one of the events that the insurer under the health plan will allow as an individual to be dropped.
All right. One more. All right, I think that's it for right now. Again, if you have any questions, you can just raise your hand.
The next area I want to talk about is HRAs. And HRAs have changed substantially under ACA, and I think once ACA is repealed, they're going to be different again. So please look at this and just realize the fact that the ACA changed many rules for employers. Under prior ACA, a HRA did not have to be integrated with the group health plan. Only under ACA was that a requirement starting in 2014. Now, first question, is an employer allowed to limit the type of benefits it reimbursed under an HRA? Absolutely. It's your money as an employer. You don't have to do any particular type of benefits. I just got asked a question 20 minutes ago. An employer wants to set up an HRA for elective abortions. And the answer is yes, the employer could do it, but they have to do it through an HRA. But if you want to just, I mean, I've created, for example, wellness programs that were in the form of an HRA where you're just going to reimburse certain expenses. So because it's your money as an employer, you can decide what and where and how those benefits will be reimbursed. Can an employer participate in an HRA if he or she is covered under another employer's group health plan? And the answer is yes. The IRS recently clarified that because remember, starting in 2014, in order to have an HRA, your plan had to be integrated with a group health plan. And so it can integrate with the group health plan of your employer and then of your spouse's employer. So that's fine, you can do this. I discourage employers from doing this only because the fact that you never know when an employee's spouse is double dipping, where he or she is reimbursed under her plan and then again reimbursed under your plan. And sometimes it's hard for an employer to police this, and that's why I discourage employers from doing this, only because it could be some double dipping involved. Can an employer limit the amount it reimburses to participants on a monthly basis? Absolutely. So unlike a cafeteria plan under a Health FSA, where there's the uniform coverage rule, where if somebody presents an expense for the whole entire balance, you have to give it to them, the situation is different under an HRA. you can say we're only going to reimburse employees up to X amount per month. That's it. So you can do that. You can limit how much you're going to spend, so you can control how the money is going out during the year. So you can even out how monies are being spent. Well, what is the penalty if an employer reimburses individual premiums under an HRA? Please remember the penalty is $100 a day for each employee. That's under ACA, and again, that will probably be eliminated if ACA is repealed. That's considered to be a violation of ACA. And so if an employer is caught doing that, and you're supposed to self-report on yourself, but again, it's a prohibition, and you could be penalized as much as $100 per day for each day that that reimbursement plan is under place. Any questions on HRAs?
We don't have any typed at the moment.
Okay.
And no hands raised.
Okay. Now, HSAs are very popular, and under the new health care bill, health reform bill, HSAs are going to be even more popular. They're going to eliminate some of the requirements. They're going to up the contribution limits. So these are going to be popular under the new health reform bill. And here are some very interesting situations. An employee is covered under a high deductible plan. He also covers his spouse. His spouse has other coverage that is not a high deductible plan. Can he contribute at the family limit? And the answer is yes. The reason why this is true is the only individual that needs to be eligible in this situation is the employee. And he, because his wife is not eligible, has to put all the HSA contributions under his plan, under his HSA. His wife, because she's not under a high deductible plan, is not eligible. So yes, he can contribute to the family limit, and it's not required that the dependent that's covered be covered by a high deductible plan. So again, this is something that, again, many people miss, and they think just because the spouse, he can only contribute at the most under the individual limit. That's not true. He can, because he has family coverage, he can contribute at the family coverage level. Another situation. An employee covers himself, his spouse, and their sons aged 21, 22, 24 in the high deductible plan. He does not claim his expenses his sons as tax dependents. Are his sons eligible to contribute to their own HSA? And the answer is yes. And each son and the husband and wife can contribute at the family limit. So in this situation, there would be 1, 2, 3, 4 family limits. So $67.50 could be contributed by each person in this situation. So, and again, the father could contribute, give the sons the money to put into their HSAs. So this is and again, what's important here, the important fact is he doesn't claim his sons as tax dependents. Now, the definition of a dependent under HSAs is different than other health plans. You got to qualify either as a qualifying child or qualifying relative. Here, they don't, and because they're living on their own, and because of that, they are not a dependent, and therefore they can have their own HSAs. Now, because of that, he cannot reimburse his children's expenses. They have their own. So again, no problem, and the limits are vast. And it says, can the employer reimburse his son's medical expenses from the HSA? And the answer is no. So there's one limit for the husband and wife. a second one for the Sun 21, another for the Sun 22, and another one for the Sun 24. Now this next situation, the top of the page 17, is a very, very common situation. This happens a lot. An employee participates under a high deductible plan with his wife and children. His wife also participates in a Health FSA at work. She can be reimbursed for his medical expenses under the Health FSA, but does not submit any expenses for him for that year. Doesn't get reimbursed. Does that affect his ability to contribute to an HSA? And the answer is yes. Now this is a very common situation, and they think, well, because I didn't get reimbursed for any expenses, I'm home free. And the reason is the rule said, could she be reimbursed? If she could be reimbursed for his expenses under the Health FSA, then it makes him, the employee, ineligible to contribute to a HSA. Now, in this situation, it's very hard for that wife to go to her employer and said, you know, I want to borrow I want to change my provisions under the Health FSA. I want to be reimbursed for my expenses and my kids, but not my spouse. Most employers won't make that limitation. So again, that employee is stuck. They have to ask the question, do you offer a Health FSA? And the spouse has to say, I'm sorry, I can't participate. All right. Can a husband and wife have a joint HSA? Very common question. And the answer is no. There's no such thing as a joint HSA. Each HSA is individual. So you can, again, put contributions in both if both are eligible, or in one, but husband and wife cannot have one HSA. If an individual has single coverage and contributes at the single coverage rate, can he or she reimburse expenses for his wife and children? This is a very common misconception. Because I have only single coverage, I only can reimburse my expenses. That's not true. As long as your wife and children are satisfied as dependents, which they are, that just because you have contributed at a single rate doesn't mean you can't reimburse their expenses. That single coverage rate only determines the contributions and not how much the employee can, the employee can be reimbursed for. Can an employee elect out of a Health FSA before the end of the plan year if he or she becomes covered under a high deductible plan? And generally the answer is no. A change in cost and coverage is not a reason to change your election under the Health FSA. Now what the employer can do in this situation is amend the Health FSA to be a limited purpose, but that employee cannot be given an election to change their Health FSA because there's no qualifying event. Amanda, are there any questions on Health FSAs?
Just a moment. A group of 2 employees with a group health plan still must have separate plan documents even though the insurance company even has a schedule of coverage?
No, no. There's one group health plan, but there's individual HSA documents. So in this situation, there's one group health plan with an SPD. But if they want to participate under a HSA, there's going to be 2 separate HSAs.
Mm-hmm.
And it's the same thing with an HRA. You have one plan document.
Mm-hmm. All right. Well, that's all for right now.
Okay. The next section is about ACA, and some of the ACA rules are going to be around for a while, despite if Trump succeeds in repealing it. Certain sections will remain in place. So let's look at some of the HSA questions I've been getting. Can an employer require an employee to work 40 hours per week to be eligible for medical coverage? At small employers, any employer with less than 50 employees, and the answer is yes. So that rule still stays in place. Now, the problem is many insurance companies have changed their eligibility to reflect the ACA rules, and they do it also for small employers. But the law does not require a small employer to use the 30-hour requirement. If an employer transfers from full-time to part-time, when can the employer drop coverage? In most of these situations, when that happens, the employer was not measuring the full-time person. They move to part-time. Basically, what you have to do is then use the monthly measurement, and you cannot drop coverage until the beginning of the 4th month after the status changed. You can't drop it right away. So again, be careful in that situation when you drop coverage when somebody drops from full-time to part-time. Can an employee offer employees an opt-out option? Yes. Who cannot be offered an opt-out option? Remember, as I said before, an opt-out option, you have to be careful. That has to be under a cafeteria plan, because basically you're paying that employee for waiving coverage. And who cannot be offered an opt-out option is anyone who is eligible for Medicare. That is seen as a violation of the Medicare secondary pay rule, so you have to be very careful who you offer an opt-out option for, because the Medicare rules see that as the violation. So generally, it's permittable. You can do it. You have to do it through a cafeteria plan. And that payment, and again, that payment is taxable, as I indicated earlier. But the new wrinkle on this is who cannot be offered an opt-out option, as that any employee who is eligible for Medicare cannot. And the only exception to that, if you're an employer with less than 20 employees. If you have 20 or more employees, you cannot do it for Medicare eligible employees. Does an employer have to provide an annual enrollment each year, even for those employees who waive coverage? And the answer is yes. That's one of the new requirements under ACA. You have to have an open enrollment every year, an annual enrollment every year. Because many employers, I should say some employers, had an option where you could waive coverage when you first entered employment, and that waiver was good for your entire employment. That's no longer true anymore. So employees have to be offered coverage every year. And you have to have evidence. So if an employee does waive coverage, it has to be written. There has to be a waiver form that employee must sign as evidence they were offered coverage. To which employees does the 90-day waiting period apply? It applies to all full-time employees. So if you have a full-time employee and you are offering coverage, the longest period of time that the employee can wait is 90 days. Now, what you can do to extend that 90-day period, you can have you can have up to a 30-day probationary period before the 90 days starts. But at no time can any full-time employee wait longer than the first day of the 4th month after their hire date. That's the longest period of time for a full-time employee. Now remember, that's different for a variable hour employee. They can wait up to 13 months to be offered coverage. But if you categorize that employee as full-time, the longest period of time they can wait is 90 days. When does the 60-day advance notice have to be provided to employees? Under the summary of benefits and coverage rules, if you make changes to a plan, and these are material changes in the middle of the plan year, you have to give employees 60 days advance notice. So that means if you're going to terminate your plan in the middle of the plan year or make any other substantial changes, you must give to those employees 60 days advance notice. And next, this is a real quandary for many employers. How does the wellness incentives affect affordability requirements? Remember, to avoid the $3,000 penalty, your coverage must be affordable. And many times with wellness incentives, employees could 1 year be eligible, the next year not be eligible for wellness. In that situation, that could affect the affordability calculation for that employee, especially if they're paying more in any year. So you've got to be real careful in looking at the wellness incentives to see how they affect your affordability calculation for the mandate. So that's something that many employers miss, and making sure that they take that into consideration. Amanda, are there any other questions, or we just have a few minutes left?
We don't have any typed right now. Again, you can raise your hand if you have any questions and we can unmute you, or you can type it in the box below. But I don't see many coming, or I don't see any coming. So otherwise, thank you all so much for joining us, and we will see you in exactly 2 weeks at 1 p.m. Central Standard Time. Again, we'll be covering how to distinguish independent contractors from employees.
Take care. Bye-bye.
Bye-bye.